Do you want to know the easiest way to buy a house? I know of a method that is so easy. In fact, I've used this method to help buy my first few homes, and I've even helped others buy their homes as well. Hey, how's it going? My name is Eric Lafuente. I own and manage a 7-figure real estate portfolio, and I own a mortgage company where I help people buy homes. And in today's video, I'm going to show you the easiest way to buy a house. First and foremost, the absolute easiest way to buy a house is with cash. However, if you are like most people, you don't have 6 figures of cash sitting in the bank. Home values in today's market are super high, and with the median income of the United States being around $38,000 a year, buying a home in some places can literally take decades if you just save money, especially when we consider homes in California and New York, where home prices can literally be anywhere between $600,000 to $900,000. At least in San Antonio, Texas, where I live, you can still buy a house for $200,000 to $300,000. Even then, if you're like me and still don't even have or want to spend all of your cash to buy a house, you're going to need to take out a loan. Now, where do you go to take out a loan on a house? But before I tell you, please go ahead and do me a favor and like this video. Believe it or not, taking out a loan is pretty simple. You need to find a place that has a lot of money and is willing to lend you some of that money. Common places are banks like Wells Fargo, Bank of America, Chase. However, they won't casually just give you 6 figures for a loan just for nothing. But do you know what they will give you a loan for? Real estate. In particular, residential real estate. To get a loan from them, you basically just need to fill out a home loan application called a 1003. You then go ahead and submit personal finance documentation such as tax returns, pay stubs, and bank statements. And based on your information, the bank will go ahead and either approve or deny your home application. Now, I did say that taking out a loan is simple, but this does not make it easy. In fact, depending on your bank, you're going to have a combination of the following: a good credit score, high income, or a lot of savings. Now, what do you do when you do not meet all the bank's requirements and your home loan application gets rejected? Well, you only really have 2 options. You either apply with a different lender or you improve your financial characteristics. Either way, when you apply to different lenders, this can be a lot of work, and this is why loan officers exist. They are there to help you throughout the entire application process. Now, when everyone rejects you because your personal finances aren't the best, there's still one way for you to buy a house, and that is called seller finance. This is also known as owner financing. Now, instead of you needing to convince a bank to lend you the money, all you need to do is convince the owner of the home to lend you the house. Just like getting a loan from a bank, you will still make monthly payments directly to the owner as if they were the lender. For most seller finance homes, the safest way to buy a house is to make sure that the home was owned free and clear, meaning that there are no debts on the house. And if there still happens to be a debt on the house, this actually complicates things, which is a completely different video. Anyways, point of the matter is, seller finance deals are one of the easiest way to buy a house because all you need to do is convince the owner of the home to sell you their house. Now here's when everything becomes negotiable, especially when the home has been on the market for a prolonged period of time. We're talking about anywhere between 60 to 100 days on the market where there hasn't been too many inquiries on the sale of the house. That's when you need to make sure you have a strong realtor and also a strong loan officer. The main point of having a good realtor is to basically negotiate the sales contract, and the loan officer is going to go ahead and handle the financial details in regards to negotiating loan terms with the seller. For most seller finance deal, the realtor is going to go ahead and arrange the sales price and also the down payments. Then the rest of the home that is not covered by the down payment turns into the form of a loan with an interest rate. If the buyer of the house has all the money that they need for the down payment, I've seen homes close within a matter of days. Let me give you an example of a seller finance home. Let's say we have a home listed for sale at $200,000, offering seller financing with a 10% down payment of $20,000. Assuming we go ahead and get an interest rate of 10% and a 30-year loan, the starting loan balance is going to go ahead and be $180,000, which our monthly principal and interest payment is going to be around $1,580. Now, it's important to note that in addition to your principal and interest payment, you also need to budget for separate payments that are covering your taxes and your insurance. From my experience, payment on your loan and payments for your taxes and insurance are usually handled separately with seller finance deals, which is different from traditional bank loans where all the payments are put into a single payment. Now that I have covered what is a seller finance deal, let me go ahead and give you some insight on how to effectively pitch a seller finance deal. To start us off, we need to start with the main reason. Why would a homeowner even consider doing a seller finance deal? That reason is because the seller of the home will be making money in the form of interest payments. I have literally called and successfully pitched the amount of money that a homeowner could make if they were to do a seller finance deal just by getting the interest payments over time. If we take a look at our past example with just a 10% interest rate at a $180,000 loan, the past owner is going to go ahead and be making around $18,000 every year on top of the sales price of the $200,000 that they sold the house for. Although seller finance sounds very appealing for everyone that is involved, we also have to consider the negatives. First, the seller is not going to be getting a large lump sum of cash as with a traditional lender. A second negative that we also need to consider is because there's less requirements and restrictions with a seller finance deal, normally interest rates are going to be higher than if you go with a traditional lender. The next thing that I want to talk about can be either a positive or a negative depending on the situation. Now, this situation depends on the current condition of the house. When it comes to the quality of the home, usually with the seller finance deal, the quality of home does not matter. The buyer of the home needs to accept the home as is. Normally, when you get a loan through the bank, and an inspection and appraisal is ordered to ensure that the home is in good condition. But with the seller finance deal, that's not the case. You are pretty much forced to accept the house as is. Now, this does mean that the buyer of the home needs to completely understand the condition of the home, meaning that the initial walkthrough and following walkthroughs of the house to see the quality of the home needs to be very thorough. Now, this does in of itself make this a risky investment depending on the property. So you need to keep in mind when you're pursuing a seller finance deal. Overall, this is how seller finance deals are one of the easiest ways to buy the house, but they are also really risky. If you are interested in applying for a mortgage, buying or selling a house, please feel free to reach out to me via phone or email. My contact information is in the description and or comments. Other than that, please go ahead and like and subscribe and have a great day.